Every economic revolution leaves a trace. Sometimes it's the railroads that cut through mountains. Sometimes it's the towers that scrape the sky. And today, it's chips. Tiny squares of silicon that quietly decide how every modern city functions. These microscopic wafers are called semiconductors, the invisible foundation of our digital world. They're in everything: your phone, your car, your refrigerator, your internet router. Each one can hold billions of transistors, tiny switches that process information at lightning speed. So when we talk about the chip industry, we're really talking about the infrastructure of modern life. Without semiconductors, no electric vehicles, no AI data centers, no 5G, no smart cities. In other words, no modern economy. And in 2025, one company in China stands at the center of this race: Semiconductor Manufacturing International Corporation, or SMIC. This year, SMIC hit a market capitalization of nearly $92 billion, about 730 billion yuan. That's a 175% jump from last year, one of the biggest rallies in the global semiconductor world. The company reported Q1 2025 revenue of $2.25 billion, up 28% year-over-year, and capacity utilization above 92%. By mid-year, net profit reached $320 million, up 35% year-over-year. For China, this surge wasn't just about market value, it was about national resilience. After years of US export bans limiting access to advanced chip tools, SMIC became the symbol of China's determination to build its own semiconductor backbone, from raw silicon to finished chips. But there's something few outside China notice. This chip boom, this push for technological independence, is also a real estate story, because every fabrication plant or fab is enormous. Each one can span more than 20 football fields, cost billions of dollars, and employ thousands of people. They need land, housing, transit lines, and power grids, all built around them. That's the hidden economy behind SMIC's rise, the concrete economy. Billions of yuan flowing into industrial parks, research zones, and worker housing, reshaping China's cities in real time. This isn't about luxury condos anymore. It's about infrastructure, supply chains, and strategic land use, the foundation of a self-reliant tech empire. So when we talk about SMIC's $92 billion valuation, we're not just talking about silicon and circuits. We're talking about the land beneath it, the property, policies, and construction boom driving China's semiconductor dream forward. Welcome to the real story behind China's chip boom and the new real estate empire growing beneath it. Let's begin.
Welcome to EstateScope, the channel where we expose the hidden forces shaping today's real estate markets. From climate risk to insurance pullouts to overlooked government policies, we break down what's really behind the headlines and what it means for your investments, your home, and your future. If you're into real estate with a twist of investigative reporting, hit like, tap subscribe, and ring the bell icon so you never miss a story that could impact where you live, what you buy, or how you build. Now, let's get into what might be one of the most overlooked real estate catastrophes of the decade.
By mid-2025, one company had become the gravitational center of China's technology market: SMIC, Semiconductor Manufacturing International Corporation. Its share price soared more than 150% year-over-year, lifting its market capitalization to around $92 billion, or roughly 730 billion renminbi, yuan. That's about 5 times larger than GlobalFoundries in the US, and now second only to TSMC, Taiwan's undisputed chip giant. It's a leap so dramatic that it raised one question across every trading floor from Hong Kong to New York: is this a true industrial revolution, or just policy-driven euphoria? Let's start with the raw numbers. In Q1 2025, SMIC reported revenue of about $2.25 billion, up 28% year-over-year. Net profit surged 161% year-over-year to $188 million, a sharp rebound from early 2024 weakness. Fab utilization hit 92.5%, among the highest in the global foundry industry. By the first half of 2025, SMIC's total revenue reached $4.47 billion, rising 23% year-over-year, while net profit climbed 35.6% to about $320 million. Yet for all that growth, its net margin remains near 6%, a fraction of TSMC's 40%. That's the paradox of SMIC's rally. Extraordinary valuation built on modest earnings. In pure financial terms, investors are paying over 100 times trailing earnings, far higher than most global chipmakers. But the story doesn't end in the balance sheet, because those numbers sit atop a mountain of capital and policy momentum. Since 2023, Beijing has poured money into semiconductor self-sufficiency, funneling hundreds of billions of yuan through the National Integrated Circuit Industry Investment Fund, also known as the Big Fund. In 2024 alone, its Phase 3 round raised 344 billion yuan, approximately 47 billion US, the largest state-backed semiconductor initiative ever recorded. SMIC, as the nation's flagship foundry, sits at the heart of this strategy. A company that doesn't just make chips, but symbolizes technological sovereignty. And investors have noticed, because when SMIC's numbers started to rise, the market didn't just price in earnings, it priced in national ambition. Each quarterly report became a signal that China's semiconductor machine was still running despite export bans, sanctions, and a global slowdown. In a way, SMIC became more than a company. It became a policy asset, backed by land, loans, and local governments competing to host its next factory. Each new fab requires thousands of workers and hundreds of acres of land. So every percentage point of growth doesn't just move stock charts, it drives construction contracts, infrastructure loans, and housing demand. That's why this semiconductor story can't be separated from real estate. When investors bid up SMIC's shares, they're also betting on the buildings rising around it, on new districts being carved out of farmland, on power grids stretching farther into Shanghai's outskirts, and on an economy trying to convert valuation into foundations. So yes, SMIC's surge is about chips, but behind every wafer of silicon lies concrete, rebar, and city planning. That's where our next chapter begins, how China's chip boom is physically reshaping its cities. Act 2. The Chain Reaction. When SMIC's market value began climbing in 2025, its stock wasn't the only thing rising. Cranes were too. Every fabrication plant, a fab, needs vast tracts of land, megawatts of power, and thousands of skilled workers. That means roads, apartments, and entire districts built from the ground up. And nowhere captures this better than Shanghai's Lingang New Area, a coastal extension designed to anchor China's semiconductor supply chain. In 2024 and 2025, local authorities allocated over 15 square kilometers of industrial-zoned land for chip production. Within months, new power substations, dormitory compounds, and logistics centers appeared around SMIC's mega-fab complex. City data shows Lingang's average industrial land price rose nearly 40% year-over-year, one of the fastest increases in the Shanghai region. This is what analysts now call the chip ring effect. Each new fab creates a ripple of supporting projects stretching kilometers beyond its walls. For every billion yuan of fab investment, tens of billions flow into construction contracts, housing developments, and utility expansions. The same story is playing out in Beijing's Yizhuang Economic and Technological Development Zone. Once home to automotive and pharma firms, it's now a semiconductor hub anchored by SMIC's northern fabs. The local government there added more than 6 million square meters of new industrial floor space in 2024 to 2025, and zoned nearly 1.2 million square meters of new industrial floor space meters for tech worker housing. Apartment developers followed immediately. Housing demand for engineers pushed rents up 15 to 20% year-over-year. The ripple even reaches southern China. In Shenzhen's Pingshan district, local authorities approved billions of yuan in infrastructure bonds to support SMIC's advanced packaging plants and the growing web of supplier factories. Where warehouses once stood, you now see data centers, materials labs, and high-density worker housing springing up. It's a classic chain reaction. One industry sparks another. Chip manufacturing needs precision gas systems. Gas suppliers expand. That needs logistics corridors, new roads and rail. That creates jobs, housing, and schools. In less than 2 years, SMIC's growth has transformed these districts into semi-autonomous urban ecosystems, what Chinese planners call chip cities. And it's not just about manufacturing. Local governments see semiconductors as a lifeline for their real estate markets after years of housing slowdowns. Industrial land sales to SMIC and its suppliers generated record revenues in 2025, offsetting declines in residential transactions. So while China's housing developers struggle under debt, a new engine is powering construction, fabs instead of flats. From Lingang to Yizhuang to Pingshan, the landscape is changing not just economically, but physically. Skylines no longer grow because of luxury towers. They grow because of clean rooms. And that shift, from speculative housing to strategic infrastructure, is redefining how China builds its future. Act 3. The construction boom. Every boom has its bankroll, and China's chip revolution is no exception. Behind every square meter of fab floor space lies an ocean of capital, much of it from the state itself. In 2024, Beijing supercharged its semiconductor ambitions by expanding the National Integrated Circuit Industry Investment Fund, better known as the Big Fund. This phase, 3-round, raised an enormous 344 billion yuan, or about $47 billion, the largest single government-backed semiconductor fund in history. Its mission? Build China's entire chip ecosystem from the ground up, from silicon wafers and lithography tools to foundries and material supply chains. And at the center of that network sits SMIC, the flagship foundry tasked with turning money into megawatts and megawatts into chips. In Shanghai's Lingang district, SMIC's new megafab, sometimes called SN2, broke ground with a 48 billion yuan investment package, half funded by local government bonds and policy banks. To make it work, Shanghai extended subway lines, widened expressways, and built an entirely new residential cluster for 30,000 workers. These are not speculative condos, they're engineered ecosystems. Each fab is surrounded by supplier plants, logistics parks, and dormitory-style housing. By 2025, Shanghai reported that semiconductor-related construction accounted for nearly 1/3 of all new industrial investment in the city. In Beijing's Yizhuang zone, SMIC's northern expansion triggered a similar surge. The city launched an industrial urban renewal plan to repurpose underused warehouse land into high-tech manufacturing parks. Over 60 billion yuan in public-private funds poured in through state banks, developers, and new investment vehicles called industrial REITs. These REITs, or real estate investment trusts, are Beijing's latest experiment, financial products that let institutional investors own shares of industrial land, fabs, and logistics parks. By mid-2025, China's industrial REIT market exceeded 550 billion yuan in assets, with semiconductor parks ranked among the fastest-growing categories. It's a financial architecture built to funnel market capital directly into the state's strategic agenda. Even smaller cities want in. In Wuhan, Xi'an, and Chengdu, local governments designated chip industrial corridors, pledging tax breaks and land use rights to attract SMIC suppliers. In total, over 20 provincial governments announced semiconductor-linked construction plans between 2024 and 2025. Collectively, those projects represent more than 1 trillion yuan, $135 billion in pledged investment, not just in fabs, but in housing, power grids, and transit lines to support them. This is industrial policy turned urban planning, but it's also a high-stakes balancing act. Every yuan funneled into chip infrastructure is a yuan not going into traditional housing projects. Some analysts warn that the chip construction boom risks overshooting, that China could end up with more fabs than feasible demand, echoing the ghost cities of past real estate cycles. Still, for now, momentum rules. Every crane, every kilometer of new rail, every power substation is a vote of confidence in one idea. that technology, not housing, will be the next pillar of China's growth. SMIC's boom has become both symbol and strategy, a bridge between policy dreams and physical development. But beneath the shine of cranes and circuit boards lies a quieter tension. Can all this state-driven building keep paying for itself? That's the question waiting at the edge of Act 4, the moment where optimism meets arithmetic. Act 4, the reality check. Every boom has a breaking point, that quiet moment when the numbers stop matching the narrative. And for SMIC, that moment is starting to take shape. By mid-2025, the company's revenue was up 23% year-over-year. Its profits, still only around 6% margin, less than 1/6 of global leader TSMC. That's the puzzle. How can a company growing so fast, with state support so strong, still earn so little? The short answer: efficiency. SMIC is sprinting, but it's sprinting uphill. Its most advanced process, known as N+2, roughly equivalent to a 7-nanometer node, remains expensive and yield-poor. Analysts estimate that for every wafer SMIC produces at this level, 4 out of 5 chips are defective. That's a 20% yield compared to TSMC's 90% on comparable nodes. Even the slightly older 14-nanometer line struggles to break 50% yield. Every failed wafer costs money: materials, electricity, labor, all burned before a single chip reaches a customer. It's not that SMIC's engineers lack skill. They're doing something extraordinary: manufacturing high-end chips without EUV lithography equipment, because US export controls have blocked China's access to it since 2019. Instead, SMIC uses older DUV, deep ultraviolet systems, forcing multiple patterning steps to reach the same transistor density. It works, but it's slower, more complex, and far less profitable. A recent TrendForce analysis noted that SMIC's upcoming 5-nanometer process, if built entirely on DUV, could cost 50% more per wafer than TSMC's equivalent due to lower yields and longer production time. In other words, each technological breakthrough comes with diminishing returns. That's why SMIC's gross profit margin fell to about 18.6% in 2024, down from over 30% before sanctions. Even after a modest recovery to around 22% in late 2024, it's still far below the 56% enjoyed by TSMC. Meanwhile, costs keep climbing, research spending up nearly 10% of revenue, and depreciation expenses rising 20% annually due to relentless factory expansion. By the fourth quarter of 2024, SMIC earned just $17 million in net income, while TSMC made about $11 billion per quarter. It's not just a gap in profit, it's a canyon. SMIC now produces less than 1/31 of TSMC's annual earnings, but trades at roughly 1/5 of its market value. That imbalance only makes sense if investors believe SMIC's future will look nothing like its past. But there's another side to this story. SMIC's profits are partially artificial, propped up by government subsidies, tax breaks, and below-market financing. In 2022, the company received 1.95 billion yuan, about $280 million in direct state grants, more than any other Chinese chipmaker. Analysts estimate that if you remove these subsidies, SMIC's true operating profit in several quarters would have been near zero, or negative. So when investors celebrate record profits, they're often celebrating policy, not productivity. That dependence creates a silent risk. What happens if the policy winds change? What if the government, facing fiscal strain or local debt pressure, pulls back on support? Without that cushion, SMIC's thin margins could vanish overnight. Still, the narrative remains powerful. To many, SMIC isn't judged by what it earns, it's judged by what it represents. A symbol of resilience, of self-reliance, of a nation proving it can build the future under pressure. But beneath that symbolism lies a financial system stretched between pride and practicality. And as cranes keep rising across Lingang and Yizhuang, investors are beginning to ask, how long can a policy-driven boom sustain itself without real profit beneath it? That question takes us beyond balance sheets, into geopolitics, capital flows, and the future of property itself. Act 5. The Global Ripple. Every empire built on industry eventually reshapes the world around it. And China's semiconductor surge, led by SMIC, is doing exactly that. What started as a story of chips has turned into a story of land, power, and politics. The ripple now stretches far beyond factory floors, all the way into ports, real estate zones, and the global trade map. As SMIC expands, the Asia-Pacific property grid is redrawing itself. In Penang, Malaysia, industrial real estate prices have jumped over 20% year over year, driven by suppliers relocating just outside China's tariff line but staying close to its ecosystem. Meanwhile, Vietnam's Bac Ninh and Hai Phong are seeing record land auctions as Chinese capital quietly backs shadow fabs abroad to hedge against US restrictions. Even Singapore, long a logistics hub, has seen a wave of data center investments as global funds chase the next node of the semiconductor supply chain. These developments reveal how China's chip drive is rewriting the real estate logic of Asia. From consumer cities to manufacturing corridors. Inside China, the transformation runs even deeper. Developers once focused on condos are pivoting toward industrial parks and power infrastructure. Cities like Wuhan, Xi'an, and Lingang are offering land leases tailored to semiconductor facilities, with state banks underwriting entire supply chain districts. Data from China's National Bureau of Statistics shows industrial fixed asset investment rising 11% year over year in 2025, while residential construction stays nearly flat. The result, a country retooling its economy from housing to hardware. But this transformation doesn't exist in a vacuum. It's happening under global scrutiny. In May 2025, President Trump warned that China has totally violated the trade deal and threatened a 100% tariff on Chinese goods unless the country stops manipulating supply chains. A week later, he told reporters that US chip design firms must halt all China sales immediately, including critical software from companies like Synopsys and Cadence. By October 2025, when China imposed new rare earth export controls, Trump called the move shocking, accusing Beijing of trying to strangle the global chip market. These statements sent shockwaves through markets. SMIC's stock dipped briefly, then surged again as investors bet Beijing would double down on self-reliance. For real estate developers inside China, it was a green light. Build faster, build domestically, build secure. The human geography is shifting too. Tens of thousands of engineers have moved into new chip zones like Lingang and Pingshan, creating boomtowns of rented apartments, tech dorms, and startup offices. Property markets around these hubs now price in semiconductors as the next source of urban demand, not just household income. This is the quiet convergence of two worlds, real estate and technology, cement and silicon. Yet for all the ambition, the risks remain. SMIC's profits are still thin, its yields low, and its reliance on state capital total. Every chip produced without EUV technology is a technical triumph, but also a reminder of the limits imposed by global politics. As one analyst put it, China's chip boom may redefine real estate before it redefines technology. Because when a country builds fabs instead of homes and power grids instead of malls, it's not just changing its economy, it's redrawing its civilization map. Factories have become fortresses, and every new district, every new warehouse, every new wafer is a statement of sovereignty. As the hum of clean rooms echoes through China's new industrial zones, one thing has become undeniable. This isn't just about chips, it's about a nation rebuilding its economic architecture, one wafer and one city at a time. The same way America's interstate highways shaped its suburbs, China's semiconductor boom is shaping the blueprint of its next generation of cities. Land once marked for luxury condos is now zoned for fabrication plants. Power grids once stretched for residential towers are being rerouted to serve cooling systems, data hubs, and the energy-hungry fabs of Lingang, Wuhan, and Xi'an. Investors who once speculated on property prices now speculate on nanometers and nodes, because the new frontier of value isn't just square footage, but bandwidth and autonomy. Beyond China's borders, the ripple continues, from Penang's industrial parks to Singapore's logistics hubs, where global funds are racing to anchor themselves near the supply chains of tomorrow. The map of global real estate is quietly shifting toward the rhythm of manufacturing, and every skyline rising from Jakarta to Shenzhen now carries the pulse of this transformation. Yet beneath the optimism lies a fragile balance, a system propped up by politics, powered by state credit, and shadowed by sanctions, where every breakthrough invites another barrier and every success comes at a cost. But progress has a way of rewriting its own rules. And whether SMIC's story ends as a cautionary tale or a case study in resilience, it has already redrawn the line between what nations build and why. Because the next decade won't just belong to whoever builds the best chips, but to whoever builds the cities that keep them alive.
Thanks for watching. If you found this helpful, please like, comment, and share to help others stay informed. And don't forget to visit EstateScope on YouTube for the full video and more real estate insights.